Hi, I'm Dan Westfall. My company's Client Focused Financial. So today what I'm going to talk to you about is why individual investors lose money. So many of you out there that are watching this, you may have a 401k plan, or you may invest in a brokerage account at like TD Ameritrade or Charles Schwab, something like that, where you manage the investments yourself. So if this describes you, listen up, because I'm talking to you right now, and this is specifically geared towards you and your money. The S&P 500, which is one of the most widely followed indices out there, it's considered a benchmark for U.S. stocks. It contains 500 of the largest U.S. companies that are out there. Based on a Dalbert study, Dalbert is just a research company. What they did is they looked at the S&P 500 rate of return going back to 1984 through 2018. Through that time frame, the average S&P 500 rate of return was 11% from 1984 through 2018. It was a little bit above that. The average investor, what they made during that time frame was under 4% though. So to give you a real life example, if you had $100,000 back in 1984 and you invested it, and you were an average investor making only about 4%, which the average investor actually made a little bit less than 4%, from 1984 through 2018, your $100,000 would have grown to about $380,000. So if you were to compare this to the 11% that the average index of the S&P 500 did, that same $100,000 that you would have invested in 1984, fast forwarding 34 years later, that money would have turned, that $100,000 would have turned into a little bit under $3.5 million. So that's a $3 million difference between the average investor and just the basic benchmark that's out there is $3 million. So why is this? So I come across it a lot where people that are out there, they make irrational emotional decisions with their investments or their overall personal finances. So there's a couple things that come into play here, and the biggest thing that I want to help you guys out with that's watching this, because I want you to get a takeaway from this, is that you need to be self-aware of what the human psychology is that's affecting you with your investments and your money. Whether you're doing them yourself or if you're going to work with an advisor, you need to understand the emotions that play into investing. There's two main human reactions that people have when it comes to investing. So one is fear, the other is greed. So naturally human beings have these emotions, and it really doesn't help with your investment decisions at all. When the market's dropping, we're naturally feeling just that feeling of like, I want to avoid this loss. What can we do to stop the loss? This is because we equate money to things like food or shelter or just overall well-being. These are just basic human instincts. So if your money's going down, naturally you're just thinking to yourself subconsciously that this is potentially you losing food, shelter, or overall well-being. So even though when the markets are going down, this would be the perfect opportunity to buy or add to a position that may be dropping in value, because over time what we want to do is we want to buy low and sell high. Natural reaction is against this. So it's not just you, this is everybody. So on the other hand, we have greed. So where I just described to you the fear example of what goes on psychologically when your accounts are going down or when an investment is going down, on the other hand of that, when you're making a lot of money and the market's going up, there's another thing that goes on where you want to make even more money. And that's where people end up getting greedy and wanting to take additional risks that may not fit their overall risk tolerance. So this is what's commonly called fear of missing out, or FOMO if you're a millennial. And if you're not a millennial, I'll teach all you old heads out there some millennial slang. So FOMO just stands for fear of missing out, and it's just the natural feeling of like, well, we should be making more money because everybody else is making more money, right? Well, if it's not your risk tolerance to be fully aggressive into the market, into stocks, then you're not going to make what the market's doing when the market's going up. So conversely, you don't want to be going down either when the market's dramatically dropping off, even though you may participate a little bit to the downside. Classic example of why individual investors lose money is the Fidelity Magellan Mutual Fund. So Fidelity Magellan Mutual Fund from 1977 through 1990 averaged an annualized rate of return of 29%. 29% is huge. The average market, like I said, over the last 34 years was about 11%, which is still on the higher end historically. Typically, it's around 10%. So this more than tripled the average return of the market historically. So the reason I bring this up is Fidelity did research on average investors that participated in the Fidelity Magellan Fund from 1977 through 1990, and what they found was astonishing, that even though the fund made 29%, the average investor actually lost money. I'll say it again, they actually lost money even though the fund itself did 29%. So this just goes back to those two main human nature, or there's two main psychological elements that are going on, fear and greed. So they wanted to get into the fund because the fund was doing so well, and then when it dropped off, what do? They pull their money out of the fund, putting it back in cash or whatever else investment they put it back into. Problem is that they ended up losing money instead of just sticking it out through the strategy the whole time. If you don't know what you're doing with your investments, be honest with yourself. Talk to an expert, put your ego aside. So if you don't, what you're going to end up doing is you're going to fall into that same average spot that all those other investors did over the last 34 years of 4% growth. Reach out to an advisor like me that works as a fiduciary, meaning that I work in the client's best interest. I'd be more than happy to have a conversation with you. It's a free, no obligation conversation. So again, I appreciate you taking the time to check out this video. If you have questions, feel free to direct message me. If you'd like to have a conversation, direct message me and we could set up a time to have a phone conversation or a video conversation. I'd be more than happy to do that as well. Till next time, thanks for checking me out.